Friends, thanks for being here today. I hit my first million at 40, and I hit my first billion at 75. Do you want to know what the difference was? I stopped doing stupid things. You see, everyone is out there searching for the secret formula to getting rich. They want the magic stock tip, the perfect market timing, or the insider information. The truth is, there is no secret. There's really just a checklist of idiotic mistakes, and if you manage to avoid them, you win. I have spent 60 years of my life watching incredibly smart people completely destroy themselves. They make the same mistakes over and over and over, and you are probably making them right this very minute. There are 7 specific mistakes that will cost you decades. I'm not talking about months. I'm not talking about years. I am talking about decades of your life. Most people don't figure this stuff out until they're about 60 years old. Totally broke, angry at the world, and blaming everyone else for their problems. I'm giving you the checklist today. If you're making even 3 of these, you are already 10 years behind where you should be. Let's see which ones apply to you. This is the simple method. There's no hype, there are no predictions. It's just about what works when everything else fails. Let's get started. So, mistake number 1. You're learning from your own mistakes instead of learning from other people's mistakes. This is the wrong approach. It is completely wrong. Look, I'm not nearly smart enough to make every single mistake myself. I simply don't have that much time, and neither do you. So what I do is I read obsessively. I'm not talking about self-help garbage, and I'm not talking about success stories. I read failure stories. I studied every single major stock market crash, every corporate fraud case, every bankruptcy. Why? Because the exact same patterns repeat themselves. The same stupid decisions, the same warning signs that everyone chooses to ignore. You think you're different? You think that when the next bubble comes along, you'll be the one who sells right at the top? No, you won't. Not unless you study what happened to all the idiots who didn't sell. I read about the South Sea bubble, which happened way back in 1720. That was 300 years ago. And people are still falling for the exact same scam today. It has a different name, but it's the same stupidity. Tulip mania, railway mania, the dot-com bubble, the housing bubble, the crypto bubble. It is the same pattern every single time. It's mass delusion. It's the belief that this time is different. It is never different. I studied the Great Depression. I wasn't even born yet, but I damn well learned what not to do. I read about the people who lost everything they had because they borrowed money to buy stocks. The margin calls completely wiped them out. So, what did I learn? Don't use leverage, ever. If you cannot afford to own it outright, you cannot afford to own it. I read every biography I could get my hands on, not to be inspired, but to catalog all the mistakes. Andrew Carnegie made mistakes. John D. Rockefeller made mistakes. Even Ben Franklin screwed up his investments. He bought into some ridiculous scheme that went completely bust. But I don't have to repeat their mistakes, because they already wrote it down for me. They documented their failures. All I had to do was pay attention. And what do you do instead? You lose a bunch of money in crypto, then you act surprised, as if you're the first person in history to fall for a get-rich-quick scheme. You buy a stock at its absolute peak. It crashes. You're shocked. But this same thing happened in 2000, and in 2008, and in 1987, and in 1929. The information was right there. There are thousands of books about it. There are documentaries. There are case studies. You just didn't read them because you were too busy watching videos about the top 10 stocks to buy right now. And here's the thing about learning from other people's mistakes. It's not just cheaper for you. It's also faster. I managed to compress 300 years of market history into just a few years of reading. I learned what killed investors in the 1800s, the 1900s, and in every single decade since. I didn't have to live through every crash. I didn't have to lose my own money in every single bubble. I just had to read about the people who did. So here's what you do. Read one investing disaster case study every month. Just one. The dot-com bubble. Read about pets.com and Webvan, companies that raised billions of dollars and went straight to zero. Read about the 2008 financial crisis, Lehman Brothers, Bear Stearns. How did they collapse? What were the warning signs they missed? Long-term capital management. Oh, this is a really good one. A hedge fund run by Nobel Prize winners, absolute geniuses. They built a financial model that said their strategy would only lose money once every 1,000 years. They lost everything in 4 years. How? Why? Read about it. Read about Enron. Don't just read that they committed fraud. Find out how they committed fraud. What accounting tricks did they use? Why did smart auditors miss it? Why did analysts recommend that stock all the way down to bankruptcy? Read about the Tesla shorts who lost billions of dollars betting against Elon Musk. What did they get wrong? Read about Bill Ackman losing $4 billion, right down to 0 cents, on Valiant Pharmaceuticals. What critical detail did he miss? Each one of these stories saves you from making that exact mistake yourself. Is it boring? Yes. But losing all your money is much more boring. Trust me. All right. Mistake number 2. You are buying things you do not understand. This one drives me absolutely crazy. I have a very simple rule. If I don't understand it, I don't buy it, period. End of story. That sounds obvious, right? Then explain to me why you bought cryptocurrency back in 2021. Can you explain how a blockchain actually works? Can you explain mining? Can you explain proof of work versus proof of stake? Can you explain why Bitcoin has any value at all? No? Then you weren't investing, you were gambling. And now you're mad that you lost. Here's what just kills me. You will spend an hour researching a $50 0-cent toaster on Amazon. You'll read all the reviews. You'll compare the features. You'll check to see if it has a bagel setting. But you'll throw $10,000 0 cents into a stock because some guy on a message board said, "Diamond hands to the moon," and posted a rocket emoji. That makes perfect sense. I have passed on thousands of investments. Huge winners, companies that went up 50x, even 100x, and I slept just fine. Why? Because I didn't understand them. And I would much rather miss a winner than lose money on something I don't get. That's the deal. You can't win them all, but you can avoid losing on stupid things. I passed on tech stocks back in the 90s. I didn't understand them. Everyone told me I was an idiot. You don't understand the internet, old man. Maybe they were right. But I also didn't lose my money when all of those companies crashed. I passed on Amazon early on. It just didn't make sense to me at the time. Jeff Bezos was losing money every single quarter, and people were calling him a genius. I didn't get it. Did I miss out? Sure. Amazon went up, 100,000%? Oops. Did I lose money? No. And that is the entire point. Here's the thing people don't get. When you only invest in things you truly understand, you avoid 90% of all disasters. You'll miss some winners, absolutely. But you will never lose everything on some fraud or some bubble you didn't see coming. I never bought Enron. I never touched WorldCom. I never invested in mortgage-backed securities before 2008. Why? Because I either didn't understand them or I did understand them and realized they were complete garbage. Either way, I kept my money. Meanwhile, brilliant people, I'm talking about PhDs, hedge fund managers, professional investors, they lost billions of dollars on stuff they thought they understood, but really didn't. They got greedy. They got complicated. They wanted to look smart. So they bought complex derivatives and structured products and leveraged instruments, and they got wiped out. Well, here's the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. The company makes money. They give some of that money to me. That's Coca-Cola. It's simple. It's understandable. It's been around since 1886. It's still selling sugar water. It's still making money. Now, you try explaining this. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. What the hell does that even mean? If you need 15 minutes and a whiteboard to explain your investment, you don't understand it. You're just repeating words you heard someone say on the internet. And here's another test. Can you explain how it makes money? I'm not talking about why the price will go up. That is not investing. That is speculation. That's just hoping some bigger fool will buy it from you later at a higher price. How does the business generate cash? Where does the profit actually come from? If you can't answer that in one simple sentence, you are gambling. So, go through every single investment you own right now. Every stock, every fund, every crypto token. Ask yourself one question. How does this make money? If you can't give a simple, clear answer, sell it. Sell it today, right now. Because you're about to learn an expensive lesson, and I'm just trying to save you from it. Mistake number 3. You're in a hurry. You want to get rich by Thursday. It's not happening. It is never happening. Look, I built my wealth over 60 years, not 6 months, not 6 years, 60 years. And people ask me all the time, what's the secret to getting rich quick? There isn't one. That is the whole secret. There is no shortcut. There is no hack. There is no loophole. There is just time and compound interest. The big money isn't in the buying. It's not in the selling. It's not in timing the market or finding the next Amazon. It's in the sitting, the waiting, the doing nothing. But you can't sit still, can you? You can't just do nothing. It's killing you. You see someone on social media make 200% on a meme stock in just 3 weeks, and you panic. I'm missing out. Everyone's getting rich but me. I have to do something. So you start trading, day trading, swing trading, options, crypto, chasing every hot tip you see on social media. And 5 years later, you have gone absolutely nowhere. Actually, you're worse than nowhere, because you paid fees and taxes on every single one of those stupid trades. Meanwhile, the boring guy who bought an index fund 5 years ago and completely forgot about it, he's up 60, 70, maybe 80%. He's doubled his money. He's sleeping well. He's not checking his phone every 5 minutes. He's not having a panic attack every time the market drops 2%. He's not arguing with strangers on the internet about why his particular stock is going to the moon. Here's the math you don't want to hear. 20% per year doesn't sound very exciting, does it? It sounds boring. It sounds slow. But 20% per year for 60 years turns $10,000 into $500 million. That is not a typo. That is not a mistake. That's compound interest. That's what Einstein called the eighth wonder of the world. Not because it's flashy, but because it works. But you don't want to wait 60 years. You want it now. You want to be a millionaire by the time you're 30, so you take risks. Big risks, stupid risks. You use leverage. You trade options. You go all in on speculative garbage. And you know what happens? You lose it all. Or you make some money, you get cocky, and you lose it all in the next trade. You don't need home runs. You don't need to find the next Tesla or Bitcoin or whatever. You just need to avoid strikeouts. Hit singles. Get on base. Don't swing at the bad pitches. That's it. That's the whole game. But your ego won't let you play it that way. You want to brag at parties. I made 500% this year. You want to screenshot your portfolio gains and post them for everyone to see. You don't want to say, I'm slowly compounding wealth over decades by investing in boring companies and index funds. That's not cool. That's not impressive. Nobody's going to give you likes and comments for that. But it works, and your way doesn't. Here's your reality check. If you've been investing for 5 years and you are not beating a simple S&P 500 index fund, you are not an investor. You are a gambler with a losing record. The S&P averages about 10% per year over the long term, just sitting there doing nothing. No genius is required. No special knowledge, no hot tips. If you're doing worse than that after all your research, all your trading, all your stress, all your subscriptions to trading newsletters and premium chat groups, you are literally better off doing nothing. Just buy the index fund, set it and forget it. Go live your life. Play with your kids, learn a hobby, check back in 30 years, you'll be rich. It's not exciting, but it is correct. And here's the really brutal part. Most active traders do not beat the index. We are talking about 90% of active traders underperforming a simple index fund over 10 years. 90%. Those are not good odds. You are not special. You are not the exception. You are part of the 90% that is losing to a robot that costs $3 a year in fees. All right, mistake number 4. You think diversification means owning everything. This is where Wall Street really screws you over. They love telling you to diversify. Don't put all your eggs in one basket. Spread your risk. It sounds smart, right? So you do what they say. You buy 50 stocks. You buy international funds. You buy bonds and REITs and commodities and crypto and gold and silver. You own everything. Congratulations. You've achieved perfect diversification and you own nothing. Here's what I've actually said about this. Diversification is a protection against ignorance. It makes very little sense for those who actually know what they're doing. Read that again. Diversification is for people who do not know what they're doing. If you actually understand investing, you don't need 50 positions. You need 6, maybe 10, if you're feeling particularly cautious. At one point, 90% of my net worth was in one single company. Was I crazy? Was I reckless? No. I understood that business inside and out. I knew how it made money. I knew the people running it. I had known the leadership for 50 years. I wasn't diversified. I was concentrated in what I knew, and it worked out pretty well. Now look, I'm not telling you to put 90% of your money in one stock. Unless you are a professional, you probably shouldn't. But here's the problem with over-diversification that nobody ever tells you. When you own 50 stocks, you basically just own the entire market, which means you are going to get market returns about 10% per year. That's fine. But you also cannot possibly understand 50 different businesses. Nobody can. You don't have time to read 50 annual reports, follow 50 different management teams, and understand 50 different industries. So, you're not really investing. You're just building a do-it-yourself index fund that has more work, higher fees, more taxes, and probably worse returns, because you'll make mistakes picking those 50 stocks. You would literally be better off just buying an actual index fund and saving yourself the headache. Here's the smarter approach. Own 8 to 12 businesses you understand deeply, not 50 names you picked from a stock screener because they had good P divided by E ratios. Not everything because you're scared and you don't know what else to do. A concentrated portfolio of businesses you have actually researched, companies you understand, industries you follow. I've said before, if you can identify 6 wonderful businesses in your lifetime, that is all the diversification you need. 6, not 60. 6 truly great companies that you understand, that have durable competitive advantages, and that are run by honest and competent people. Buy them, hold them, and get rich slowly. And if you don't deeply understand individual businesses, if you don't want to read annual reports and follow earnings calls and study competitive dynamics, then just own an index fund. Seriously, that is not a failure. That is self-awareness. That is actually smart. Most people would be way better off in an index fund than pretending they're stock pickers. There's no shame in it. The shame is in owning 50 stocks you don't understand, underperforming the market, paying unnecessary fees and taxes, and wasting your time. That's shameful. So, here's what you do. If you own more than 20 individual stocks right now, you are over-diversified. Cut it down. Keep only the ones you truly understand and believe in. If you can't explain in one sentence why you own it and how it makes money, sell it. Today. And if that means you end up with just 5 stocks or just an index fund, good. You've just improved your portfolio and saved yourself years of mediocre returns. Mistake number 5. You are hemorrhaging money on fees and taxes and you don't even notice it. This one is boring. I know. Nobody wants to talk about expense ratios and tax efficiency and fee structures, but it is costing you tens of thousands of dollars, maybe hundreds of thousands, maybe millions over your lifetime. Let me show you some math. Pay attention, because this is important. Let's say you're investing $10,000, 0 cents per year for 30 years. That's pretty standard. Scenario 1. You use a low-cost index fund, a 0.04% expense ratio. It's basically free. You buy and you hold. You don't touch it, you don't trade. At 10% annual returns, you end up with about $1,800,000. Nice. That's a good retirement. Scenario 2. You use an actively managed mutual fund. It has a 1% annual fee. That doesn't sound like much, does it? Just 1%. One measly percent. You get the same 10% returns before fees. But after fees, you actually get 9% per year. You end up with about $1,500,000, 0 cents. The difference? $300,000. Gone, vanished, into your fund manager's pocket for the privilege of underperforming the index. That is not a typo. A 1% fee just cost you $300,000, 0 cents, over 30 years for nothing. Actually, it's worse than nothing, because most actively managed funds don't even beat the index. So you are paying more to get less. Brilliant. And that's just the expense ratios. That's just the annual fee. Now, add in trading commissions if you're constantly buying and selling. Add in the bid-ask spreads. Add in capital gains taxes every time you sell something for a profit. Short-term capital gains, if you held for less than a year, can be taxed at 37%. Your top marginal rate, long-term capital gains are 15 to 20%. That's still significant. Most active traders are giving away 30 to 40% of their gains just to fees and taxes. Then they wonder why they aren't building wealth. I'm up 50% on my trades this year. Great. After taxes and fees, you're up 30%. Congratulations. You worked your tail off, stressed out for 12 months, and you barely beat the index fund that required 0 effort. We obsessed over this for decades. We held stocks for 30, 40, even 50 years, specifically to avoid paying capital gains taxes. Why sell? You pay taxes, you lose 20% right off the top. Now, you have to find another investment that's 20% better just to break even. It's stupid. Our company doesn't even pay dividends. Do you know why? Because dividends are taxed immediately. The government takes its cut before you can even reinvest it. We would much rather keep that cash inside the company, reinvest it in more businesses, and let it compound tax-free for decades. That is how you build generational wealth. Not by paying taxes every single year on dividends and capital gains. But what do? You trade constantly. You sell your winners way too early because you're scared of losing your gains. You hold your losers way too long because you're too stubborn to admit you were wrong. Every trade equals fees. Every short-term sale equals higher taxes. You are working against yourself. You are bleeding money, and you don't even realize it. So, here's what you do. Calculate exactly how much you paid in fees and taxes last year. Actually do this exercise. Go to your brokerage account. Look at your 1099 tax form. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios if you're in mutual funds or ETFs. Add it all up. If that number is more than 1% of your total portfolio value, you are trading too much. You are paying too much. Cut it out. Switch to low-cost index funds. Stop trading. Hold for the long term. I'm serious. This might be the single most important piece of advice I can give you. Minimize fees and taxes. It's not sexy, it's not exciting, but it might be worth an extra $500,000 to you over your lifetime. Pay attention. All right, mistake number 6. You let your emotions make your decisions. This is the big one. This is what destroys most people. This is why smart people with good intentions end up broke. Your biggest enemy isn't the stock market. It's not the economy. It's not China or inflation or interest rates or the Federal Reserve. It's you. It is your emotions. Your fear, your greed, your panic, your FOMO, your fear of missing out. When the market crashes, you panic and you sell everything. When the market is booming, you get FOMO and you buy at the very top. You do the exact opposite of what you are supposed to do. Buy low, sell high. It's great advice. Everyone knows it. Nobody does it. You know what people actually do? They buy high when everyone's excited and everything feels safe. They sell low when everyone is panicking and it feels like the world is ending. They do it every single time, like clockwork. Let me give you some real examples. March 2020. COVID hits. Nobody knows what's happening. The market crashes. The S&P 500 drops 34% in 1 month. It was the fastest crash in history. Panic was everywhere. News channels were just showing death counts 24/7. Everyone was terrified. What did most people do? They sold everything. It's going to zero. This is the end. The next Great Depression. Cash is king. What did we do? Nothing. We just sat there. Actually, we bought more. The market was on sale. Great businesses were trading at huge discounts. Why would we sell? And what happened? The market fully recovered by August. It hit all-time highs by the end of that year. Everyone who panicked and sold at the bottom, they locked in their losses permanently. Then they were too scared to buy back in. They missed the entire recovery. It was the greatest buying opportunity in a decade, and they did the exact opposite of what they should have done. Then 2021 comes. The market is booming. Everything's going up. Crypto is going insane. Bitcoin hit $60,000. Dogecoin, NFTs, meme stocks, GameStop, AMC. Everyone was making money, or so it seemed. This time is different. New paradigm. The money printer goes brr. What did most people do? They jumped in with both feet. I'm missing out. Everyone's getting rich but me. I need to get in now. FOMO was a hell of a drug. What did we do? Nothing. Actually, we were sitting on $150 billion, 0 cents, in cash. Just sitting there, doing nothing. People called us idiots. They're too old. They don't get it. They don't understand crypto. They don't understand memes. Boomers. This time is different. We heard it all. And what happened? 2022. The market crashes. Crypto crashes. Bitcoin dropped 70%. All those meme stocks gave back everything. NFTs became worthless JPEGs. All those diamond hands turned into paper. All those people who bought at the top in 2021, most of them are still underwater, still just hoping to break even. Meanwhile, we had $150 billion, 0 cents, in cash, ready to deploy when everything got cheap again. Here is the pattern you need to understand. When you feel like you should sell, when your gut is screaming at you to get out, when you're checking your portfolio every hour and you can't sleep at night, that is usually when you should hold, or even buy. When you feel like you need to buy, when everyone around you is making money and you're feeling left out, when it feels like easy money and you'd be an idiot not to get in, that is usually when you should wait, or even sell. Your emotions are designed for short-term survival. Run from the lion. Fight the enemy. Don't eat the poisonous berries. This is great for keeping you alive in the jungle. It is terrible for building long-term wealth. Your short-term panic instincts will destroy your long-term financial future. So, here's what you do. Write down your investment rules. Right now, not during the next crash, not during the next bubble. Right now, while you are calm and rational and not emotional. Write them down. I will not sell during a market crash unless I actually need the money for living expenses. I will not chase hot stocks just because they are going up. I will not check my portfolio more than once a month. I will not make investment decisions based on fear or greed. Whatever your rules are, write them down, print them out, put them somewhere you will see them. And when the next crash comes, and it will come, and your emotions are screaming at you to do something stupid, you read your rules, follow them, not your feelings. Your feelings are trying to kill your financial future. Mistake number 7, and this is the killer. This is the one that destroys more wealth than all of the others combined. You quit too early, you give up right before it works. Most people try investing for 2, 3, maybe 5 years. They don't get rich, they get frustrated, they get bored, they quit. They say investing doesn't work, the game is rigged, only the rich get richer, the little guy can't win. And then they go back to buying lottery tickets and complaining about the system. Here's what they don't understand. Wealth compounds slowly at first, very slowly, painfully slowly. For the first 10 years, it feels like nothing is happening. You're putting in money every single month. The numbers go up a little, then they go down, then they go up a little more. It's boring. It's frustrating. You look at your account after 5 years and you think, that's it? After 5 years of discipline and saving and investing, that's all I have? This is pointless. I get it. I understand the frustration. But here's what happens if you just keep going. Year 15, year 20, year 25, year 30, suddenly the numbers start moving fast, really fast. Because you're not just earning returns on your contributions anymore, you're earning returns on your returns. You are earning returns on the returns of your returns. That is compound interest. And it is exponential, not linear. The first $100,000, 0 cents. It takes forever. It feels impossible. You're grinding, you're saving, you're investing, and it takes years to hit that first milestone. But the second $100,000, 0 cents, happens way faster. The third happens even faster. By the time you get to your fifth or $600,000, they're coming every year or two. That is the magic of compounding. But you only get there if you do not quit. I didn't make any serious money until I was in my 50s. I didn't hit my first billion until I was in my 70s. That's 30, 40, 50 years of doing the same boring things over and over again. Buying good businesses, holding them, reinvesting the dividends, letting it compound, not selling during crashes, not chasing bubbles, just being patient and disciplined for decades. Most people do not have that kind of patience. They want results now. And when they don't get them, they quit. They try stocks for a few years. It doesn't work. They switch to real estate. That doesn't make them rich fast enough. They try crypto. That blows up. They try options trading. That loses money. They try day trading. That loses more money. They spend their entire lives jumping from one strategy to the next, never sticking with anything long enough for it to actually work. Well, here's the truth nobody wants to hear. The stock market has returned about 10% per year for the last 100 years. Through world wars, through the Great Depression, through recessions and crashes and bubbles and panics and everything else, 10% per year, on average. That means if you invest consistently and you don't do anything stupid for 30 years, you will build significant wealth. Not maybe, not probably. You will. It's just math. It's inevitable. But you will be tempted to quit. Oh, you'll be so tempted. In year 3, when there's a crash and you're down 30% and everyone is saying it's the end of the world. In year 7, when your buddy made 500% on some new cryptocurrency and you're only up 80% and you feel like an idiot. In year 12, when it just feels like you're running on a treadmill going nowhere and you're wondering if this is even worth it, That is when most people quit. Right before the exponential growth phase kicks in, right before all those years of patience start paying off big time. Don't be that person. Don't quit. You've already done the hard part. You've already suffered through the slow years, the boring years, the years where it feels like nothing is happening. If you quit now, all of that was for nothing. But if you keep going, if you give it another 10, another 20 years, you will be in the top 5% of wealth in this country. Guaranteed. So here's my last piece of advice, and then I'm done. Pick a strategy. Index funds, dividend stocks, value investing, whatever. Something boring and proven. Something that has worked for decades. And then you stick with it for 30 years minimum. Not 3 years, not 5 years, 30 years. Don't quit when it's hard. Don't quit when it's boring. Don't quit when your friends are making more money doing something else. Don't switch strategies every 2 years chasing the next hot thing. Just keep going. Keep contributing. Keep reinvesting. Through crashes, through booms, through boredom, through FOMO, through fear. Just keep going. That's it. That's the whole game. Avoid these 7 mistakes. Be patient. Be disciplined. Don't quit. You won't get rich in 5 years. You probably won't be rich in 10 either. But in 30 years, you'll be wealthier than 95% of the people in this country. And you'll have done it without stress, without gambling, and without getting lucky. Just by being patient and not being stupid. Now, if you've made it this far, you are serious about this. Most people have already clicked away looking for the top 5 stocks to 100x in 2024 or whatever other garbage is trending. Good. That's less competition for you. It means more opportunities for patient people who actually understand how this really works. So let's talk about that for just a minute. This idea of boring. People hate boring. They associate wealth with excitement. Fast cars, big moves, frantic trading on multiple screens. That is not wealth. That's a movie. Real wealth, the kind that lasts for generations, is built in silence. It's built by owning a piece of a company that sells soap or soda or insurance. The 8th deadly mistake, if you want to add another one to the list, is envy. Envy is by far the stupidest sin. It's the only one you can't possibly have any fun doing. You just sit there and feel miserable. You aren't mad that you don't have enough to live. You're mad that someone else has more. And in today's world, with everyone posting their wins online, their new car, their vacation, their 10-bagger stock, envy has become a full-time job. And it forces you to break all the other rules. Envy makes you impatient. That's mistake number 3. It makes you buy things you don't understand. Mistake number 2. It makes you emotional and irrational. Mistake number 6. You see your neighbor, who you always privately thought was dumber than you, suddenly driving a $100,000 car because he gambled on some tech stock. And you think, I'm smarter than him. I deserve that. So you abandon your 30-year plan. You sell your boring index fund, and you dive into the same garbage he did. 6 months later, the car is repossessed and you are both broke. You just paid $100,000 for a lesson you could have gotten for free by reading a book. You have to inoculate yourself against envy. How do you do that? You have to run your own race. You have to sit down and define what enough actually means to you. Is enough $1 million? Is it $5 million? Is it just $60,000 a year in dividends so you never have to go to an office again? Define the goal. Write it down. Once you truly define that goal, all the noise just disappears. Who cares if someone else made 500% on a risky bet? It doesn't affect your plan. You aren't running their race. You're not trying to be the richest person in the cemetery. You are just trying to hit your number. This brings me to the 9th mistake, not knowing when to stop. People get addicted to the game. They hit their $5 million number, but then they look over and see someone else hit 10 million. So they change the goal. They take on more risk. They leverage up. They're trying to get to 10. and they blow themselves up. They go right back to zero. I have seen this happen more times than I can count. People who had everything, people who had already won the game, but they kept playing because they were addicted to the scoreboard. Don't be that person. The goal isn't just to get rich. The goal is to stay rich. And staying rich is a completely different skill set. It's not about playing offense. It's about playing defense. It's about avoiding those 7, or I guess 9, stupid things. It's about recognizing that once you have enough, the upside of having more money is not worth the downside of losing that money. A 50% gain from that point doesn't really change your life, but a 50% loss does. The math is just brutal. You lose 50%. You need a 100% gain just to get back to even. Why would you take that risk if you don't have to? So, keep it simple. Avoid stupidity, read history, be patient. Keep your emotions and your envy in a locked box, and know your enough number. You do that for 30 or 40 years. You'll be fine. You'll be more than fine. Go do the boring things that make you rich.